Hello and welcome back, guys. So in this particular session, what we'll be discussing about is Skizer's part B, okay, from question number B. And then what we've been given is that, so I think I can close this. So external disclosure of information on intangible is useful only insofar as it is understood and is relevant to investors. It appears that investors are increasingly interested in and understand disclosures relating to intangibles. A concern is that due to the nature of IFRS disclosure requirements, investor may feel that the information disclosed has limited usefulness, thereby making comparisons between companies difficult. Many companies spend a huge amount of capital on intangible investment, which is mainly developed within the company and thus may not be reported. Often, it is not obvious that intangibles can be valued and even separately identified for accounting purpose. The integrated framework may be only maybe one way to solve this problem, right? So discuss the potential issues which investors have with accounting for different types of intangible assets acquired in business combination, choice of accounting policy of cost or revaluation models allowed under IAS 38, intangible assets, capitalization of development expenditure, and discuss whether integrated reporting can enhance the current reporting requirements for intangible assets, right? So first A, so accounting for different types of intangibles, right? So intangible assets acquired in business combination, right? So as per IFRS 3, business combination acquired intangible assets must be recognized and measured at fair value, right? In the beginning, fair value. If they are separable or arise out of contractual rights, legal contractual rights, once recognized, IAS 38 requires intangible assets with indefinite life to be subject to an annual impairment in accordance with IAS 36, right? And that's for the intangibles. After that, however, it is unlikely that all intangible assets acquired in a business combination will be homogeneous and investors may feel that There is different types of intangible assets which may be acquired for example patent may only last for finite period, right? Finite period of time and may be thought as having an identifiable revenue stream. In this case, the amortization of the patent gradually replaced by the purchasing entity's own intangible assets. For example, customer lists, and it may make sense to account for these within goodwill. In such cases, investors may wish to reverse the reverse amortization charge in order to decide whether an amortization charge makes sense. Investors require greater detail, right, about the identified intangible assets. IFRS standards do not permit a different accounting treatment for this distinction. Alright, so what could be the other issue that we need to talk about is choice of accounting policy, right? Issues with choice of accounting policy, okay. So what could be the issues with accounting policies with accounting policies? IAS 38 requires an entity to choose either cost model or revaluation model for each class of intangible assets, right? Intangible assets. Under the cost model, after initial recognition, what happens basically? Intangible assets should be carried at cost less accumulated depreciation, amortization, less accumulated impairment, right? Accumulated impairment. Under revaluation model, intangible assets are carried at recoverable amount less accumulated amortization less small a should be small a accumulated amortization less impairment less ACC impairment. Okay, related impairment, right? This is how it is basically measured. The revaluation model can only be used if there is active market for intangible asset, right? For intangible asset. But such markets are not common. If an intangible asset is reported using cost model, the reported figures would be understated when compared with fair value determined under the revaluation model, right? Moreover, the ability to choose the revaluation model or the cost model may limit comparability between entities. Is right. So what is the next thing that we need to talk about is capitalization of development expenditure. Okay. So capitalization of development expenditure, right? Capitalization of development expenditure. IAS 38 requires all research costs to be expensed and development cost is only capitalized if the technical and commercial feasibility of the assets for use or sale has been established. If an entity if an entity cannot distinguish the research phase of an internal project create an intangible asset from the development phase, the entity treats the expenditure for that project as if it were incurred in the research phase only. This cautious approach ensures that assets are not overstated. The problem for investors is that companies do not have a consistent approach to capitalization. It is often unclear from disclosure how research expenditure was distinguished, right? Because it will be at the same, like, between the same time frame as well, and then the cost cannot be actually distinguished, like, very, it does not say anything about that, from development expenditure, right? And there is no consistency as well. That's the main important thing. It may be that entities allow bias to impact their decision making in this area. Intangible assets disclosure can help analysts understand the innovation capacity companies. Investors can use the disclosures to identify companies with valuable development asset. Once these launch in the market, they should generate economic benefits, potentially increasing investment returns. Preparers of financial statement are failing to adequately comply with the disclosure requirement of IAS 38, which limits their usefulness, because it's similar to, it's nothing, it does not explain anything. That's why it's useless, basically. So what else? It talks about how whether integrated reporting can enhance the current reporting requirements for intangible assets. Okay, so let's talk about that as well. Integrated reporting. Measuring the contribution of intangible assets to future cash flows is fundamental to integrated reporting. This helps explain the gap between the carrying amount of net assets and its market equity value. Okay, that's where it becomes very essential. And as set out above, organizations are required to recognize intangible assets acquired in a business combination. Consequently, the intangible assets are only measured once for this purpose, right? However, the organization are likely to go further in integrated reporting or in their integrated report disclose the impact on intangible assets as a result of sustainable growth strategies or specific initiatives. It is therefore very useful to communicate the value of intangible assets in an integrated report. For example, an entity may decide to disclose its assessment of the increase in brand value as a result of a corporate social responsibility initiatives, because that basically improves it as well, right? TBR integrated reports, entity initiatives. Okay, so this is basically how we answer this kind of question. So next, what we should be looking at is table score, so which will be question number 26 as per our SPR's exam kit. Okay, so yeah, this is how we should be basically talking about it. So the new thing that is basically over here is it talks about what are the issues with business combination, right? Intangible assets acquired during business combination, and then what are the issues with it, and then the accounting policies issues, whether what happens when we use when one entity uses cost model for intangible asset, and then whether when the other entity uses a revaluation model, then the comparability between the entities is cannot be achieved, right? So we talked about that as well. And then capitalization of development expenditure, what are the issues, like, because the main issues there will be is that there is no consistency, do not have consistent approach to capitalization. Okay, so this is the most important thing. So basically just like paying a taxes for a certain amount, like we talked yesterday, right? So even if it's just an average, a weighted average rate, so if the capitalization amount was a certain percentage of that, so it would be easier for the investors to predict their cash flow, so that's what we are basically, that's what they are mostly concerned about. So and then even the disclosures as well, so disclosures, just the figures is not very clear. And then what was the distinction between the research expenditure and the development expenditure is also not given in the disclosure. That creates a bit of confusion in the investor. How did they distinguish? So that would have been useful, right? And then in case of reporting, integrated reporting, the disclosures, additional disclosures regarding intangible assets, and then that will help us explain, the gap between the carrying amount of the net assets and the market value. Why are the investors placing so much value? It's because they might have a certain intangible assets which will generate further cash flows, right? So they are looking at the future, right, based upon its growth. So it basically helps to explain that gap, the wide gap. Some of them might have wide gaps. So why is that? Because the investors might be favoring it favorably because they know that there is an intangible asset or which is already in development, and it will go into future production, which will generate more revenue for the business, and then they can basically profit from it. So yeah, those are the issues with intangible assets reporting that we talked about. And then we also talked about what's the difference between IAS 38 and the new conceptual framework uh, as well, right? So yeah, if you have any confusions until now, please do comment down below. I'll definitely answer it for you. Until next time, bye bye.